Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, December 27th, 2023. It's 2:55 p.m. Eastern Times. I'm starting the video, so this one probably get out to you after the close, shortly afterwards. And I just want to wish everybody happy holidays as we head into the final few trading days of the year here. What I'm going to do in this video is we're going to start with looking at the big three. The big three are what I call the Treasury bond market, Treasury bond yields and bond prices, of course. The major currencies, which is the US dollar and the euro, and then of course, the stock market. So we're going to go through in that order. We're going to start with bonds first, then the euro. Then I'm going to spend the bulk of the time on the stock market. And in that, it'll have a three-prong approach. We'll look at the indexes, of course, first and foremost, point out any key levels, potential developments to watch there, then drill down into the sectors of the S&P 500. I probably won't cover all 11 sectors of the S&P because those bottom tier, they don't really move the market. The REITs and the basic materials and utilities, they're great to trade if that's what you're focusing on, if there's trading opportunities. But as far as their weightings in the S&P, it's under 3% on most of them, are right around 3%. So we'll look at those top sectors, financials, tech, healthcare, industrials. And then we'll also look at, finally, the Mag 7 and see what the charts are telling us there. All right, starting out here, this is TNX. So if you want to take just kind of a big overview picture of the bond market, these are TNX, of course, is the yield of the 10-year Treasury bond. Well watched by most market participants. It's really what the 30-year mortgage tracks to, even more so than the 30-year bond. We'll look at that in a second, the 30-year bond as well. But you can see a very well-defined downtrend line. This is a secular bear trend that we had in interest rates over the last nearly half century. This goes back to 1981 when rates peaked. That was the last high inflationary environment we had in the 70s leading up into the early 80s there. And then we've been in a falling rate environment. In fact, we had a really nice price channel we were trading down in, but then that was interrupted by bouts of extreme central bank intervention when the financial crisis, you can see back here in 2008, all the quantitative easing and excessive artificially low rates. And then they followed up with other bouts of it. Of course, that ended with the nuclear option when COVID hit. All the global central banks just going, central banks gone wild, and the governments too, fiscal and monetary stimulus, and so that ended it. That will go down in history. I think most will agree because we pretty much hit the floor on rates as the the end of one of the longest secular bear markets and rates in a long time. So. Anyways, by all metrics I've talked about, we've taken out all the previous highs. We've taken out the primary well-defined downtrend line, and so now where do we go from here? Longer term, I believe the trend will be higher rates, but that's longer term, and we just talked longer term on that current downtrend. That was a span of nearly half of a century. So very easy to when you put it into longer term perspective. That's not today, tomorrow, next week. We're talking years from now, even decades out. But in the near term, you just get clobbered trying to trade a long-term trend if you're fighting it, on day-to-day, week-to-week basis. So that's kind of just bigger picture stuff where we're probably headed. But what we do want to look at is, the charts on the 10-year yield. We had the recent divergent high. It was, to me, one of the best setups we've seen in a while. We capitalized. We milked almost all of it, getting in long Treasury bonds right before rates started falling hard. One of the biggest bond market rallies in years, if not decades, especially in such short order. Now, where do we go from here? That's why we're doing the video. So the 10-year is undercut. There's some support right here. It's undercut. Again, we're coming off that divergent high. I suspect there's going to be more downside in yields in 2024. This is a potential target right there around 31.10. That means 3.1 in yield on the 10-year Treasury, and potentially a backtest of the trend line. However, I suspect, and it's my prediction based on my analysis of the charts macro fundamentals, everything else, that we won't continue to see that hyper sensitivity between interest rates and the stock market. So far, which I'll get to in a second, the turn came, rates were going up, stock market was going down, and as soon as rates reversed, the stock market has rallied in lockstep with it, as I mentioned, because the stock market's been hypersensitive to interest rates when they reach this multi-year high. So now where do we go from here? It all is related. So, you can study the charts of the S&P 500 in a vacuum, try to trade that if you're trading the indexes or trying to figure out where the stock market's going, whether you're an active trader or a 401k investor, or you can greatly enhance your predictions, or your analysis, I should say, by including the charts of the Treasury bonds, including the charts of the euro and the US dollar, which we're going to do here. So based on that, on this week, no, that's a monthly time frame, my bad. On the weekly chart, I can see about 3.33 or 33.33 is good support on the 10-year if we continue to fall. But again, there's some things that tell me we're probably going to get a counter trend bounce before we get down that way. And if we do, maybe up to around here somewhere. Again, this is a weekly chart. Now you go down to the daily. Oh, that's messy. Let me just go to the weekly. Let me flip it around. Let's look at the bonds themselves, because most of you don't trade yield. If you are trading bonds at all, you're trading either Treasury bond futures or a bond ETF. And IEF tracks the 7 to 10-year bond. So it's really the 10-year bond, we'll call it. And you can see we had that bullish falling wedge. It's where, we went long TLT. We used TLT for more juice. And so again, I don't see a lot of resistance here on the 10-year until you get up to here, and it's very, very good resistance. So whether we pull back first or not, I would definitely keep an eye on that level. I would put extremely good odds that if we rally, especially if we get there soon without a correction first, we'll be very overbought, and that would be an excellent place to reverse, close out any longs you still might have in the 10-year. Or turn around and short it. And again, I'm doing this because you might not even care to trade Treasury bonds, but if you've followed me for a while, you've been able to predict or you've seen the markets moving in lockstep with this. Here, I told you I would show it. That's just for those new. Turn it on. You can look at QQQ or SPY. They're going to look at this. They move in the same direction. No mistake at all that they both bottomed right here. This is QQQ and SPY. There's Treasuries. They were all going down into that low. And so you can see the core, they move in lockstep, and they have for a while. Again, historically, that has not been the case. Typically, you have an inverse, or I should say historically, there's been an inverse correlation between stocks and bonds, meaning one goes up, the other goes down. But in this environment, that's not the case. So there will be a disconnect at some point. I believe that's coming in 2024, where we won't see them moving in lockstep. There'll be periods where they will, most likely. And again, it'll most likely be if rates start shooting up again, where the stock market becomes sensitive to that and sells off. Okay, so there's IEF on the weekly time frame, but let's look at TLT. That's the one we've traded recently. It's been our trade idea. We entered that on the trade on that one was back here on the 60-minute chart. We went long in the breakout of this bullish falling wedge, right in at the lows, hit T1, T2, T3. My fourth and final target was right here. And then recently added out as an official pullback trade and giving you 1, 2, and potentially 3 target. I call it potential third target zone because we'll see if and when we start to approach T1 or T2, I'll decide whether or not to extend the trade. As of now, this is the final target for that trade, T1, T2 zone. And, if you haven't taken it because the uptrend is very strong, bonds have been, powering higher. So if you want to play it safe, the levels to watch, I'm going to zoom in here on TLT. Right here, you have that number says, because I've had that line there for a while, 98.38, but just below that is about $98. So 98 and this uptrend line, beautiful uptrend line, come in together. And so a break of those levels would most likely trigger a pullback in bonds, a correction in bonds that it was going to take us down. You can see there's also this potential trend line. Now it should come in with T1. That's right here. And again, the takeaway is, make no mistake about it, if and when that happens, I can all but guarantee you stocks are going to follow it down, because that is going to be, remember, that pullback in Treasury bond prices will be a spike in yields. That correlation never goes away. It's an immutable inverse correlation between yields, what the bonds are paying, their interest rate, and what their prices are. That never changes. The correlation or inverse correlation, positive or inverse, between the stock market and bond prices, that's an on-off kind of thing. All right, so that's it. That's what that looks like on TLT. We look at IEF. You can see the same thing on the 60-minute chart. You've got some divergence building, and you have another uptrend line right here. I haven't really marked this one up. Remember, we went with TLT for the juice. My confidence was high in the trade. So TLT rallied up to my 4th target when it was hit. Well, I have to do this because I don't have a target for IEF. I'm just going to measure up to the high. 22% rally. If you went with the lower beta IEF, you only made half of that, 9%. Not even half of that, 9.17% up to the recent high. So that's just the fact that the longer maturity bonds have more interest rate risk, so they tend to move up and down with rates more. So one more chart, and we'll move on to currencies and get into the stocks. TLT, I recently told you that personally I decided to just kind of, with the holidays and everything, just kind of hold off, suspend any stops. This appears imminent right now, a correction in TLT. We don't have the sell signal yet, and I'm referring to this chart. I shared it with you last week. You can go back. This goes back several years. These are your year breaks right here. There's 2023, 2022, 2021, and this is 2020 right here. So what I did here, without any fail, without exception, I went back in the purple lines, mark all the overbought readings, overbought being 70 or level higher on the RSI. And sometimes it's one or done. You have a little tag, but quite often you get these little clusters of overbought readings. And as I often say, overbought is not a sell signal, just like oversold is not a buy signal. Just like negative divergences are not a sell signal, they are a condition, just like overbought. So what is a sell signal, at least in this case, when used in conjunction, are these bearish PPO crossovers. So that's where the yellow line comes in. So you can see it's immediately after, or I should say shortly after the overbought readings. You want to look for a high level. High level means above the zero line, well above the zero line. High level bearish PPO crossover, which we got there. Then you got that. You had a cluster of overbought readings here. There was a PPO crossover. You did get an initial correction, but it was mostly sideways for a while, sideways to down. Even then, you had an ever so slightly higher high there. But if you were using this as a trend trading signal to get out of your longs and into shorts, at worst case, you went sideways. You would have never had a stop violated because it got you right there, right off the highs. You had an ever so slightly higher high, and then the big drop came. So keep that in mind, that it doesn't always give you an immediate down, although in this instance, if you look at without exception, you did have an immediate down there as well. And you also had a sideways trading range. You had a couple downs. You stayed right where you were at the sell signal. You never went above it, so you would have never been stopped out. But if you were trying to play the long game, going for a much bigger drop, it would have taken a while to play out, because this is where the real drop came after you broke that floor. But I just want to point out the track record has been 100% over the last couple of years. Again, when you get the overbought readings and then the PPI bearish crossover, doesn't guarantee it will be again. We were also in a downtrend on bonds. We've had some powerful technicals recently, so it could be the first failure. But most importantly, we don't have the sell signal yet. It looked like the lines were going to cross here. One way to see it, first off, you have to squint. You can't tell, then it's not a sell signal, I like to say. But when you put up the PPO histogram, this is the histogram. You need to have on the daily closing basis, a red histogram bar. That's when you get the PPO crossovers. Again, you're looking at a high level. These are low level. These don't count. You want to see the high level. There it is right there. There was your sell signal on that one. There was your sell signal right here on that one. And there was your sell signal on that one right there. So it points to a very likely and impending correction to come on treasuries. And I already showed you the correlation between the stock market, so we'll wait for that signal and I will update you when we get it. Next up, let's talk forex. Let's talk the euro US dollar pair. You can look at just the dollar, you can look at just the euro. The euro is 57.6% of the dollar index, so it's, by far the largest component, with the yen being a very distant second at like 23. So the euro is basically upside down dollar, if you want to look at it that way, and that's why I use this chart. What I can tell you factually is we have just like a lot of things, like on the stock market, we have these divergences forming, but we have to confirm the divergences. That's a term I've made up. I don't know if it's anything official. You have, by all accounts, this is negative divergence when prices are making higher highs over the previous highs and the indicators are making lower highs. However, these are momentum indicators. The momentum is pointing higher because prices are moving up, and it may continue. And so what I like to see is a bearish PPO crossover to effectively put in a lower peak. And so that's what I'm looking for there. Now, that'll probably come after a sell signal. Sell signal will come. You can see this steep uptrend line on this daily chart. I marked it S1, meaning first support. It's an intersecting uptrend line and the 110-ish price resistance or support level right there. And that's a pretty good level. When I go back, I have a lot of reactions on that level right there. And then T1, T2. T2 also comes in with this larger uptrend line. So that would be my current potential swing target. I can all but guarantee you if that happens. I can't guarantee you it will play out. I can't guarantee you'll get a buy or sell signal. What I can tell you is we don't have a sell signal right now, but we're very close. So I'm doing this video so you can mark up these levels, set some price alerts. I'll jog down to the 60-minute chart in a second. And what I'll show you as well is turn off all the lines. And just so I do this often, but it bears repeating. You put up the stock market and you can see an unmistakable correlation. The white line I just put up is QQQ, QQQ, and the stock market, SPY, QQQ, they move together. When the euro is rallying, that means the dollar is falling. Stocks are going up. Gold is going up, gold and silver, because the dollar goes down in value, takes more US dollars, that makes stocks go up and makes gold go up and everything else. So you want to watch that. And again, so taken together, if we can get and identify some decent sell signal on bonds, like I just showed you, we go down and rates go up and bond prices go down, especially if we can couple that with a sell signal on the euro. That would give us a high probability sell signal on the stock market. So let's go down to, so those are your potential targets. This just shows the oversold. Last time we were oversold readings. And then 60-minute chart, if you want to sharpen your pencil, come down here. The last time I pointed out a 60-minute bearish rising wedge pattern a couple months back was right here. You had a nice clean uptrend line in which to trigger a sell signal. There was our divergence right there. Divergent high, that was a sell signal. I gave you 3 targets, 1, 2, 3. We hit T3, slightly undercut it, and then put in a divergent low as highlighted at the time, and that gave us this rally. Again, you can overlay, or I'll do it again, and make no mistake about it. There's the S&P 500, and you can see it's quirky when you overlay them with this one, because remember, this Euro USD trades around 24/7, so you don't see these lines are kind of jaggedy because they're half the time it's trading. The S&P or SPY was closed because it only trades during 9:30 to 4 p.m. All right, let me turn that off. All right, you get the point. So there's this is a setup. There's your sell signals. There's support right there. Is really good support about, again, what I told you earlier on the daily about 110 and then the uptrend line. So if we can break down here, again, breakdown looks like it's imminent and likely. Breakdown, hit that level. There's your first target zone right here. Second potential target zone. And right now, let's say third max. So we'll see where we go there. QQQ, remember we're in that low volume, low volatility holiday grind, but we still have the same uptrend line I've been talking about for a while here. If you recall, was it last week or the week before, I gave you a short-term setup for active traders. I gave you only 2 targets on the 60-minute, T1 and T2. Let me move that over. we hit T1 to the button. This was the setup was a break of this smaller wedge right here. And then I gave you a little that there was a level there on the showed you on the futures, I think it was, that would do the trick, and that did the trick. It took us down. That was our biggest 60-minute candle, red candle in months right there. And it took us down. We hit T1, give you an opportunity to cover as an active trader and or a game of bounce. But I still maintain T2. It's yet to be hit, and it won't be hit unless we take out the more significant longer-term trend line right there. And we're right on it right now. So there it is. We had a divergent high back then. Sometimes you break down, never look back. And quite often you break. Well, we actually, no, take that back. We hit support. Now we need to take out the more significant longer term trend line. And you can see what I've done here. Remember, I gave you this bearish rising wedge measured target. That's this purple line, which is the widest part of the wedge. If you take it from here to here, that's where I measured. And right there. So now that added, let's just say this breakdown happened to come tomorrow morning, or later today at the close or tomorrow soon. You can see it's a perfect measured target down to T2. I have not changed T2. It's still 392 or hair above it. And that's what would take us down there. Now, whether there's going to be more or not, remember, I still have longer term targets on the daily chart. And of course on the weekly, that's an ugly board. There it is. These are longer term targets. Back here, we shorted way back here on that break. We hit T1, T2 right here. We bounce. I posted at the time covering all shorts and going long and expecting the bounce. Gave you two scenarios. My preferred, which was we would bounce but then go down, or my alternative scenario now goes all the way back to September 18th, which would have entail a marginal and still divergent high followed by a drop to all price targets. And that's exactly where we're at. So that alternative became my preferred once that we took out the recent high. And so that's it. So we already hit T1, T2. So if this plays out, these would be your next longer term swing targets based on the daily. And I'm going to spend a lot of the rest of the time of the video covering the weekly charts. I just want to say that nothing has changed technically. I want to just kind of sidestep for a minute here and talk about what's going on in the market. I acknowledge what I'm seeing and what's being talked about on TV and in the media and it is hard to find fault with this market, with this rally right now. First of all, yields have abated. Because of that, you've seen broad market participation, in other words, market breadth. Remember, a couple months back, I pointed out how a lot of stocks were lagging. You had divergences on the various breadth indicators, and it was mostly the Mag 7. Lately, we've seen the rest of the market really starting to pick up, and the big Mag 7 passed the baton to some of those. So, and that, of course, is healthy. We've seen yields come down, and what I've noticed is we haven't seen really any uptick in credit spreads. And that's usually, if you're going to see a credit spreads, it's kind of been an on-off thing. Back in the days, those that really knew the markets, pros, and, you've been doing this like I have for a long time, to keep an eye on bonds. The bond market is usually a lot smarter than the stock market. The pros, that's where they play and they look for clues. And so quite often you could see credit spreads during a stock market rally, especially an extended run. You'd start to see credit spreads widen. And that means that junk bond, low quality bonds are paying more and more a higher spread or rate over safe treasuries. But I have seen in recent years too, I've seen some big drops and major turns come where there haven't been any heads up where you saw that in advance. In other words, credit spreads started shooting up only once the stock market started falling. So I just want to say that's not flashing. So there's really no sell signals flashing. And as I said last week, I made a prediction. It's kind of quirky. I've never made this kind of prediction, but I'm almost predicting a black swan event. And what I mean by that is, I know by definition, a black swan event means it's unpredictable. It comes out of nowhere. Nobody. And I don't know what it'll be, so I'm not predicting any particular thing. But most likely, if I'm right, and I'm doing this, it's not a stubborn, hey, I'm going to hold on to that 2024 bearish outlook, much more, much larger downside targets. No, it's because everything I'm about to get into right now in these charts, I'm going to show you that nothing has changed technically. The same case I've been making now for months is still very much intact. And it may not be for a lot longer. So I'm going to talk about that. But so how's it going to play out if everything is starting to firm up and this whole soft landing thing is now fully entrenched and by just about everybody out there saying no recession in 2024 at this point. It's just going to be a rosy year. That's where I say if the charts are going to play out and these technicals and everything I'm about to cover for the rest of this video, you're going to have to see a surprise in the market somewhere, I believe, because it's all but guaranteed we're going to see rate cuts from the Fed. Of course, that's quite unusual. The Fed's only taken rates back now to a normal rate, we're, historically, an average for the Fed funds rate, but yet, for some reason they're going to be cutting. We'll see. And a black swan, it could be anything. It could be a bank problem with a bank or non-bank financials. There's a lot of them out there, the whole shadow banking system. And, there's hedge funds, there's pension funds, there's money market funds, there's broker dealers. So problems could come from anywhere. And, call it a prediction, call it what you want, doesn't matter. It's what it's going to take right now to knock off, because there's a fundamental case, again, falling interest rates and extra and more liquidity from the Fed, assuming everything's hunky-dory. We're seeing credit conditions ease. I'm not bought in yet because, again, I talked about this recently. The 30-year mortgage and interest rates are only back to where they were before when the stock market was at its lows in 2022. So it's kind of insane. So what the markets are doing, guys, this is where I'm going with this. The markets are pricing in. Let me go back to trade. They're pricing in that yields are just going to continue to fall drastically, and they may. In fact, that kind of, at least to an extent, aligns with what I'm looking at. However, where I think we differ is I think at some point you're going to see that rise, falling yields, which is a rally in bonds, come from more of a flight to safety risk because something's happening in the financial market, something that is driving institutions to sell stocks and move money into bonds like they have for 100 years, the historic norm. The old 80-20 rule may work once again. All right, so I suspect that will happen. And yes, I'll call that a prediction. I've been talking about that one for months now, but I also said it would be a slow handoff. It wouldn't be overnight. And we're starting to see that. Here's another day today. I see bonds up nice, but yet the indexes have just turned red. You can see here as I'm looking at QQQ down slightly, nothing big. All right, let's just look at charts and I'll wrap this up so it doesn't take too long. We still have very, very clear and steep negative divergence on QQQ as well as SPY. I'm on a weekly chart. I'm really going to focus because we're heading into 2024. I want to talk bigger picture. And again, remember, this was and still is what was my alternative and clearly became my preferred scenario once we made that marginal new high. And as I said before, it wasn't when I put that scenario out back here. This is where I posted covering all shorts recently, getting long, bullish. Didn't take it all the way up, unfortunately, and started trying to short because my preferred scenario back then was that we would do this with an alternative that we might go a little higher, marginal new high, and then do that. But that's not wishy-washy, contrary. The market may go up or it may go down analysis. No, because I had us going to the same spot. This was a long-term analysis with long-term targets that are way down here, 40% plus downside. And so when you're talking a marginal, meaning slight new high, the difference is minimal. And so I want to be clear. To say that the market's going to go to new highs and up 30, 40% or can do this, that's useless analysis. That is nobody good. So I wanted to be clear. It was, I still had us, and still my primary scenario still has us going to the same levels. In other words, still has this as being a bear market rally and nothing more. Again, I'll get to the other indexes in a second. QQQ is not the stock market. It's not the economy. In fact, it's just a overweighted, unbalanced tech index. The Wilshire 5000, S&P 500, the more diversified indexes are still not up above their 2020 late 2021, early 2022 highs. And So the levels to watch right now on QQQ, this is a weekly chart. I'm going to step it down to the 60, but there's that negative divergence right there. And we have, if you look at it this way too, I think you can see it here. It's very subtle. You have a much larger divergence right here as well. See that line right there? And yeah, it's starting to steepen now. But that's much larger, big divergence. It's been building since that high back there and when we peaked in November of 2021. So there's your divergence line now. And you can go back in time. Here, I'll do it for you on the S&P 500 here because I have it marked up. The S&P 500 has yet to make a marginal new high, again, over the early 2022 high. But if it does, if it makes an equal or slightly higher high soon and then reverses, you can see the divergence, that yellow line will be much larger. Now we have divergence right now on the S&P 500, negative divergence there. There is a PPO crossover, and we need to roll down soon to confirm it. This is what I was talking about. This is a momentum indicator. If we go higher, we can take out this high. And then, of course, if we take out this high, then you no longer have divergence. It doesn't mean the market can't drop from there. It just means I won't have a good case to make. But this is the same case I've been making. This hasn't changed. And I put a very high weighting in this. This stuff plays out much more often than not. Not always, but much more often than not. You can roll back as long as you want here. This is 1998, 22% drop off that divergent high. We extended it, made an even larger divergent high into the bull market highs in March of 2000, followed by a 51% drop. One of the only two true bear markets, in my opinion, in the past, half century nearly. 2007 highs, 57% bear market. And again, look at the scope of the divergence. That was multi-year divergence that took into that highs, and that's where bear markets come from. They typically the bigger the divergence, whether it's steep like this, that's a more steep divergence than that divergence line, or the longer, and or a combination of both. Typically, not always, but typically the bigger the drop. So, over time, you had a divergent high here, 22% drop. Divergent high, 10, 15, 15, 21, 36, that was COVID. 28 off the most recent divergent high. And so we don't have divergence right now from here to here. We do have it here. And we will, of course, if we do equal or exceed that high. And so many don't want to hear it, but unless that changes, this outlook clearly to me says that there's not only a reversal coming, but a drop that's probably going to exceed that 28% drop we had. In other words, I still maintain this was the first leg down in a larger bear market with a lot more to come. Now, let's talk about being wrong, or what I call wrong, early, or right. Okay. If I'm dead wrong and all the bullish case, again, I don't have to make it. If you wanted me to, I would do it. I could talk for an hour all the bullish developments I've seen, in the last few months, especially with rates falling. And if that all holds up and we don't have any explosions, any black swans, or any big problems, or any cracks in the financial system, yeah, great. Then there's a great fundamental case, and maybe even a technical case. We start taking out these divergences. But if we go up, anything more than a slight marginal new high and then reverse, if we go up 10% or more, I'm just wrong, dead wrong. And I'm certainly aware of that and what it would mean if I'm shorting, especially if I'm aggressively shorting it or I'm not diversifying and don't have other positions offsetting that. If I was only trading the stock market, which I never do, but if that was my only position, and you don't want to fight a 15-20% run up in 2024 to 2025. It is certainly possible. To say it's not, you'd be a fool. So if that happens, I'm just dead wrong. If we go up a little more in reverse, because I've been calling for it since here, then I'm early. I have over the years, I make a lot of stuff up trading, but to me, there's a huge difference between being early and wrong, or like I like to say, being right, early, or wrong. Being right on a trade, to me, because you know me, I love precision. Sometimes I can call tops and bottoms with near impunity. Sometimes I'm or a little early, and sometimes I'm just dead wrong. So you have to account for that. Don't put too much into anything I say or any one trade, no matter what my convictions are. Trade based on what you think things are going to do, and use stops that are in your line with your risk reward, your risk tolerance, and your risk reward ratios, and all that good stuff. Being right is when you nail the bottom, like we did on Treasuries. We've got in at the bottom. We got out a little bit early, but again, I hit my final target, so that's 100% right. Being early is what I consider right now, initially not favoring a marginal new high in QQQ or SPY in the market. And that would have been right if we shorted here when I put back after covering shorts here, when I started shorting it back right there, that would be right. And then being that this was a marginal new scenario, again, I'm talking to the longer term positioning, longer term trade, still a scale in for me, soft short. If that happens, we go up and then we do head on down, and we have a, well into the double. We go on to hit these targets, these next targets here. Then that is being early. It's getting in a trade, going a little underwater, or going sideways in time with that trade not turning profit, not hitting a price target, but yet not being stopped out. So that is the difference between being early and wrong. Wrong means you got into a trade, it went against you, and it exceeded your stop or any reasonable stop. That's being wrong. Even if it does ultimately pan out, even if goes up here, you get stopped out, and right after you get stopped, it goes on to hit the price target, that's wrong. Okay, so that makes sense. I want to cover a couple more things here. Well, these are all potential targets these are targets I laid out a long time ago. When we first topped, I gave you near-term T1 on SPY, near-term T2, and then long-term T1. That was a bear market target. We hit it almost to the button. We bounced. And so, again, that's how things, how I saw things and still do see them playing out. Bear market rally's been a little bit longer and stronger than I would have anticipated, if that's what it is. And if it's not, I'm just wrong. But if we do go on to hit long-term T2, long-term T3, you have this uptrend line. And I gave you an additional target I added recently, long-term T5. It's all the way down here. That means if that fifth target's hit, that's going to be a 55% drop. And it wouldn't happen today, tomorrow. Probably wouldn't even happen in 2024. It'd probably be several years out, at least a couple years out. Okay, so that's just wanted to point out we have those divergences. And again, this is all long-term stuff here. Short-term, go back to that 60-minute chart of QQQ. Look for things like that trend line, look for sell signals there. And then we'll just assess if and as that happens. If and as a correction starts to develop, how are things looking? What are Treasury bonds doing? What's the euro doing at that point? Do they look like they have more to go? Or is it time to cover and get along get on board with this FOMO trade on the long side? Okay, this happens. It's happened twice today. I've already tried to do this video, and sometimes the pause button you hit and it doesn't pick back up when I uncheck it. So I don't know where it left off. I just want to recap. This was divergence here on XLK back here. We had divergence building. That was DH1 right here. Correction 1. The divergence got bigger up to this point, DH2, another correction. And finally, all one larger divergence with these smaller divergent highs along the way right here. You can see them marked. Finally culminating and ending in that 38 or 40% drop right there. And the divergent lows, were little along the way. And you can see we had divergent low, and we traded all these. We covered shorts, and we went long there on that one, and that one. And you can see the bigger the divergence got. Again, we had smaller divergences with smaller rallies, but then we had a culmination of 3 consecutive divergences that finally result in that big counter trend rally, and then ultimately this big divergent low down here at the bottom, or a separate divergence right there if you look at the RSI. And then boom, rally, divergent low, rally. So that's where we're at now. We had a divergent high. We had a pretty good correction that ended here with that divergent low, right? We covered our shorts there, went long. And this is where thought we might go down, but we made that marginal new high scenario. That marginal new high overbought with negative divergence. And there's a 60-minute chart right there. Pretty big divergence on XLK. Next sector, XLV. Again, I'm not going to go through all sectors. Let's look at the weekly chart. You can see here I have a primary uptrend line on XLV. This is the bull market uptrend line from off the 2009 lows. So there's our secular bull. This drop here was COVID. I nicknamed that, and not just in the healthcare sector, but in the stock markets, I call it Ursa Interruptus, meaning a bear market interrupted by the Fed, the federal government, all governments around the world, all central banks flooded the system with liquidity and snapped us back. But it's interesting to note, we're back below that trend line. We broke down, but put that aside for a second. Probably the most important thing to me is this sideways trading range we've had for this goes back to middle of 2021 right here. And the healthcare sector has been grinding around sideways. It's still like almost every sector. In fact, all the key sectors of the S&P 500, only two have made new highs, and that's XLK, which is tech, and XLI industrials. They're all the rest of them are down well off highs that were set back in either 2021 or 2022. You can see that. And that was a divergent high. But bottom line is, it appears to me high level consolidation or a topping pattern in healthcare. Now, I will say this. If we break to the upside and it's a sustained breakout and it doesn't fail, then that's bullish. When you get these kind of consolidation periods, you look for whichever way they break. You can see my purple line, lights out below 119. That's bearish. This to me looks a lot like many sectors and indexes, such as the small caps. If you recall back in this is a weekly chart here, the small caps right here. In 2020 to 2021, all the way up into almost in the beginning of 2022, we had an almost identical trading range, a topping pattern. We had a breakout that proved to be a failed breakout. As I often say, breakouts that occur with negative divergence and overbought conditions, which is exactly what you had, will often fail. And when it failed, we went down below. We shot down below the trading range, hit my first price target, bounced. That became major resistance. It still is. It went on, got rejected off that level, hit my second price target, bounced. And you can see this is T3 and T4 right here. So this is where I think the small caps are ultimately going. I know right now they're getting a lot of attention. They're poised to break it. They're even breaking out. I'll tell you, they're breaking out. But again, it's a breakout that's probably going to fail. This is the bigger trading range we've had for the last couple of years. And you can see it's just popping above there. It could stick. As long as rates fall, that benefits small caps more so than anything. You want to do a pairs trade. If you can short the mega caps and go long the small caps for some potential alpha there, because small caps will probably outperform. However, if we get another surge up in yields, you don't want to be in these guys. This could fail. And my guess is it probably will. Why? Because my long-term targets haven't been hit. These are targets I laid out back in the beginning of March of 2022. You can see when I put that T4 there, back here, before anybody knew there was a bear market coming, or very few. And I still think it'll be hit. It's just a matter of how are we going to get there. It's been a, kind of a consolidation period, and I think we'll work our way down there. Okay, so the point on that was this is, similar kind of setup here. Healthcare is held up, rightfully so. It's a defensive sector, meaning, during a recession, which we haven't had yet officially, you get sick, you don't stop going to the hospital or the doctor. So healthcare stocks usually hold up then. But ultimately, like in all bear markets, you can just pull up a chart and they will succumb and go down. Financials, I don't have a strong opinion, but they peaked way back here. They peaked in the end of 2021, beginning of 2022, like the market. Pretty big resistance right here. That was the bottom. That's where they broke down right there. And we had a reaction high right there. So they're at resistance. I don't have a strong opinion on the chart. Just wanted to cover it because it's the third largest sector. XLY, consumer discretionary. Here's a primary uptrend line right here off the 09 lows. And we have 1, 2, 3 distinct reactions. So that's a potential target, but more so if we break that, that's quite bearish. And you can see the negative divergence that we have right here and here. Just like you had a divergent high there, 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 and before that right there. See, XLY, the consumer discretionary sector, that's where Amazon and Tesla hang out. And they're, again, this is from last year, 23% weighting for Amazon. Tesla was about 11, or probably a little higher now. But you're getting down to the wire, down the line here, where this is now only a 10% weighting. So this is less than half. Even the financials are less than half of the tech sector as far as the performance of the S&P 500. All right, let's just look at the Mag 7. I can go down the line. There's the other one I just should show you. XLI, the only other sector, major sector in the S&P. It's at new highs, but big divergences. Again, you can see that divergence has just been, it's huge. And it fits into what how I saw this next bear market playing out. It's much different from any that we've seen in recent history. And I'm talking going back half a century now. I think just about everyone, I haven't heard anybody that, well, maybe a few that the kind of mindset aligns with mine, but most are they're trying to frame it in, the fact that, okay, we had a bear market. It was over in 2022, 15 to 18 months drop. That's what we saw in 2000, 2007, 2008, those relatively short bear markets. And I think, again, based on the secular trend change in interest rates, tells me that we're into something a lot like Japan's lost decade, where we're talking, which is really 2 lost decades now. And you can pull the Nikkei, you can Google search Japan's lost decade, read up on it, read up on the similarities, real estate, credit bubble pop, zero interest rate policies, quantitative easing, everything they did kind of, 20 years before us. All right, let's go to the Mag 7, or I'm never going to finish this video. Mag 7 QQQ, where are my names loading? Sorry, guys, I have a watch list that should be loading the components. Today, it's not doing that. That's weird. Okay. Now what I can do is, what I'm referring to is a watch list off the side here, right there. I can do SPY because they're the same holdings. When I'm queuing in QQQ just today, once in a while, this program will has a little quirk in it, and it'll showing me those only 3 holdings of QQQ. That's not the case. So I'm just going to go to SPY and go through them because, again, they're the same stocks. Apple, weekly. Let's just talk long-term, big picture. We can go to short-term picture. Next, with the 60-minute chart, there's divergent high 1, correction 1, 21%. Divergent high 2, even bigger divergent high, right? Bigger correction. This little divergent high here gave us a 21% drop. Then the divergence got bigger, gave us a 32% drop. And this is the same divergence. You can see it, just bigger. By that logic, I am looking at a much larger than 32% drop. In fact, I have never waffled on this. I've always maintained a current final long-term target around 82 and or this primary uptrend line on Apple. So a drop to 82 now. And look, again, early or wrong, that's up to you. If you were short Apple back when it peaked in November of 2021, the stock, when you look at this, and we can do it from our perspective. So we are up today. Let me just go here. No, let's not even do today because that wouldn't be right. Let's do the recent high. We went up 8%, but yet I'm calling for a drop and have been down here. That's a 55% drop from that level, which is now going to be even a little higher. So if you were looking at a 55% drop, you could easily give yourself a 15%, even a 20% stop loss and have an attractive RR, 3-to-1 roughly risk reward ratio, and you're still short. Let's say. Now, of course, I'm an active trader. I don't, I'm in and out. I've been in and out of Apple a dozen times since then, including at the beginning of the year, listing it as one of my two favorite stocks out there. I think it was Apple and Amazon, was it? Those two. And went long and strong, in the beginning. Wish I would have held it all the way, but either way, you've been in and out since then. And so when I look at this chart, I what I see now is a much more bearish setup than back here when we shorted it and wrote it down, most of it for that 32% drop. There's a trend line right there. Again, this is long-term charts, and if you You either believe in these things or you don't. And the divergences, divergent high, 39% drop, divergent high, 35, divergent high, 34, divergent high, 45, 16, 15, 26, 62. Okay, so this stuff, doesn't always, but it usually works, and that's what it's telling me, and that appears imminent. And you can see the divergence too. It's getting steeper. The line here, this is our bigger divergence line. It's starting to really slope down, and that's because the momentum is really stalling out. The buyers are drying up. All righty, Microsoft, nothing changed. Divergent high 1, we were short there. I gave you back on January 4th. You can pull that video up. T1 right here. I bet you very few in the world at that time on January 4th, which right here, we're calling for a drop down, to have Microsoft get drop 35%. And we hit T1. Not only did we hit it, but we bounced from there. And that's why I list multiple targets. This was T1. This is T2. We made a slightly marginal new high. But the technicals back then, the same case that I had for shorting this stock back then, there was your breakdown, there was your sell signal on the break of the trend line, there was our divergent high. That divergence is even larger now, and that meshes with an expectation for an even larger drop. If we hit T2, then Microsoft's going to fall 47%. I can all but guarantee you I am not going to be correct on this call, meaning Microsoft drops 47% without the stock market going down 30 or 40%. It's all but guaranteed that if I'm right on this, then I'm right on the stock market. There's going to be a big drop coming. And by the way, that's only my second target. I still have and maintain. I added this one after T3. This is a longer term bull market uptrend line that goes all the way back to 2009. That, as you can see, the arrows I have drawn, I expect to hit. So this is how, right now, again, I'll see if and when we get there, but this is how I'll probably game this one. Be covering there, like I was covering here, go long, and then short again. Again, that's a rough kind of sketch right now, but that's how I could see that playing out. Alphabet, come on, I know it's the same stuff I've been talking about, and it gets old. Divergent high, divergent high, divergent high. And, I didn't measure this one. You can measure it yourself. These are big drops. And they were just really corrections. That's what you can see how I labeled them here, corrections. This is our primary secular bull market uptrend line in Alphabet right here. And so really these were, I don't even consider them bear markets, although they were drops. They met the old school definition. That was a 34% drop when COVID hit. And again, it wasn't random. COVID might have been a random event, a black swan, but it was priced into the charts. We were going to have a correction with these divergences. And we hit our primary uptrend line. We hit it there again, hit it there. Thing is, I think we'll come down to them again, but ultimately I think these bull market uptrend lines are getting very long in the tooth. And based on where I think rates are going, ultimately the trend lines break, and then we will have entered, at that point, most likely, a new secular bear market. Now, it's not all doom and gloom. Thing about it, and you can look at the Nikkei, the bear market rallies were phenomenal to trade. Go look at the Nikkei, pull a 20, 30, 40-year chart, 20, 30-year, measure the bear market rallies, and there's a lot of them. So there'll be plenty for everybody along the way. But anyways, this is my outlook, and again, all the reasons are in there. And you go down, out to the monthly charts, and I won't do that now. I don't have a lot on Alphabet. Alphabet hasn't been around that long. Remember, they came public back in 2004. You got to go to some of the other ones like Amazon and Apple. All right, and there's another, there's that what I showed you before on the healthcare sector and small caps. You had that multi-year consolidation, 2-year sideways consolidation with 2 false breakouts to the top that came with divergences. And like I said, breakouts that occur in negative divergences have a higher rate of failing. Finally, we broke below the bottom of the trading range there. Tried to rally back, got rejected. We're still there. We're high. We're in the bottom quarter of that trading range, but you can see the negative divergence. The only thing missing here right now are those bearish PPO crossovers. So I'm very much watching for those. I'm watching for the near-term trend line breaks. Again, I'm spending most of my time on these weekly charts, and you can see right here clearly. Well, I see it. This is an uptrend line that when that breaks, that's a likely target, if I'm correct. Of course, it depends if and when it breaks. That's going to be about a 12% drop. But then remember, longer term, these are longer term targets down here. This is a huge level. This is where I was, along with Apple, bullish on Amazon at the beginning of the year as my two favorite stocks. That was a great setup there. Divergences, everything I like to see. And now it's come full circle. It's full run, negative divergences, just like you had here. All right, NVIDIA divergent high was there. It's still making equal highs, so that's still divergence, the negative divergence. Maybe it wants to pop up and put in a marginal new high. Maybe not. I don't know. All I can tell you, the last divergent high right there, the stock fell 69%. Divergent high before that, it fell 56%. Divergent high before that, 86%. Actually, that one's not measured. There was a small one there, and that was still a 50% drop, 90% drop. So, and this is where I think the stock is going. And I know that's heresy because this is a crowd favorite. And this is NVIDIA, everyone's favorite AI stock. But I'm still maintaining my next look. And we hit my first target there. We bounced to the button. These were targets put in place in the beginning of, nope, I lied. Okay, I made that target right there in September of 2021. That one as well, September 21. We hit it to the button. That was back here right before this thing topped, or right around that time, or just before. Hit that to the button, and this is how it works. Sometimes you hit these targets, you get it's a pretty good reaction, but I still maintain T3 and T4. At least T3. I think T3 at minimum. T4, I'm kind of, maybe we'll see. Just to get to T3 now, we got to drop. This stock has to drop 85%. And I know what you're saying when I say that. Oh, Randy, you're crazy. But it's the nature of this beast, especially in that. And again, guys, these were bull market corrections of 90 and 86%, 56%, 69. Just imagine for 1 second we do enter a new secular bear market. Is it that unusual to expect? Simply, in the case of NVIDIA, simply a return just to visit their secular bull market uptrend line, which is right here. And that's what would have us going all the way down to that deeper target. And that could still keep this stock in a longer term secular bull market, right? All right, I'm going to wrap it up here. That's a long video. We're just under the hour mark. I'll get it out to you. And again, it's the holidays. I'll be in and out of my desk over the next few days. But if you have any questions, comments, want a chart request, an opinion on something, just post it below this video. And I'll get back to you as soon as possible. This has been Randy Finney with Right Side of the Chart. Have a great day.